Welcome to the webinar today. Thank you all for joining us. We are thrilled to have with us Liz Faircloth. I'm going to go over just a couple things about Liz, but before I do that, I just want to mention that this full webinar is being recorded and I will be sending it out to you all tomorrow via email, and I'll also send you over Liz's PowerPoint slides, and we'll be in touch with a couple other goodies that Liz has offered to our members. So a little bit about Liz. She co-founded the DeRosa group in 2005 with her husband, Matt. The DeRosa group is based in Trenton, New Jersey. They are owners of commercial and residential property with a mission to transform lives through real estate. I love that. And DeRosa has raised tens of millions of dollars, worked with hundreds of passive investors, and controls thousands of residential and commercial assets throughout the East Coast. So this webinar is really built for investors of all sizes and stages. Liz is going to share some of her ups and downs throughout this whole process. We're hoping that you'll learn something, maybe get a little inspired to grow your portfolio and look at maybe some new ways that you can go about doing it with, the strategies that Liz has used herself. So I'm going to have Liz share her screen and have her dive right in because she has so much to talk about. Liz, thank you so much for coming on and doing this presentation. We are really excited to learn a little more about investing today.
Yeah, no, Alexandra, thank you so much. It's been a pleasure connecting with you on a number of things. It's been awesome to work with you and the organization and really helping because we really have been able to scale, and we've been doing this for 16 years, which I'll share a bit about. So I'm really excited to share things we've done well, things we wish we did better, I should say, and where we are today as well, and what our focus is. So I've weaved in some lessons here. This is going to be interactive. So please put your phone away, get focused for the next hour or so, because I really want to be of most help. But Alexandra, thanks for having me.
Yes.
I'll jump in here.
Yeah. And by the way, put in your questions in the question box. I totally forgot to say that because I'll be checking in as Liz is talking so we can answer your questions as we go along. So please don't be shy. Put in your questions there and I will take a look. I'll be on patrol there on the question and answer box. So I'll take myself off video for now, but take it away, Liz.
Okay, awesome. And as we get acclimated, I'd love to see, I'm a big fan of seeing what's happening in the chat box and engaging with all of you. So if you don't mind, just share your name, where you're calling in from, and what you want to learn about today. Obviously, I have slides. I have prepared a bunch of different lessons here to give to you and hopefully help you in some way. But I'd love to hear what's on any of your minds, how it could be of most help and service to all of you today. Because time is one of those. Everything else is unlimited and abundant, but time is limited in a lot of ways. So I really want to make this time well spent for all of you. Hey, Tina Williams, I know you, Tina. Good to have you on here. So yeah, please just share, your name, where you're calling in from. Tina is one of our InvestHER meetup leaders. So excited to have you on, Tina. But cool. Hey, Molly from Denver. Thanks for being here. Very cool. So yeah, please share your name, where you're calling in from as I get going here. I've never heard of that in California. Very cool. Financing options. Well, good stuff, Lorenzo. I will definitely be talking a little bit about how we've been able to scale from a financial perspective, because that's a big one, right? As we scale, how to sell single family homes and condos and put it all into one managed multifamily rental. I'll probably weave some of our story in there, but that's a great question. I could probably field at the end as well, Amir, because that's a particular strategy. You could do it in a couple of different ways, especially depending on who owns those single family homes. So we're not going to get into the nitty gritty, but because you can actually do like even maybe a 1031, depending on what assets are owned by whom. But we'll go there. We'll definitely I'll speak about actually 1031s as well. So very cool. Technology, that's a good one too, to scale multifamily. I'll speak a little bit to what we use as well. So that's a great one, Molly. Good stuff. I'm glad I'm looking at this because I want to, again, make this most helpful to all of you. Yeah. And yeah, there's some interesting things when it comes to 1031s. So we'll speak to that. I'll definitely be speaking to that because that's an interesting one for us. Cool. Awesome. Financial. All right, cool. Joel, thanks for being on here. So I'm going to get going. I do have a lot prepared for you. Please keep posting where you're from. Again, any of these kinds of sessions is a nice way to connect with you as well as for one another to connect. So I'm going to jump in a little bit about me, my story, for those who don't know who I am. Again, my name is Liz. Excited to be here. I am a wife. I'm a lot of different things, but these are a few of the hats I wear. I do love to run. I do love wine as well. But we started investing, me and my husband, in a nutshell about 16 years ago. Actually read Rich Dad Poor Dad, which I'll speak to, about 20 years ago, which really began the process of my path. I was actually getting my degree in social work. I wanted to be a counselor. I wanted to be a therapist. And reading that book totally changed my view of what's possible around, passive income, and then getting involved in real estate and taking courses really opened my eyes to this whole world of real estate. So through the 16 years we've been focused on investing, my husband and I co-founded the DeRosa group, which is mainly focused on syndicating apartment complexes at this point. And we have about 120 million under management, mostly on the East Coast. So we have properties in 4 states. I'm also the co-founder of the real estate InvestHER community, which our mission and our passion is to empower women to really become financially free in a balanced way. So that's an apartment building we have. That's a half Ironman I did when I was crazy and younger. And that's my family, which is my big why of why I do everything I do. So a little bit about InvestHER. Again, we're here to empower women to live a financially free and balanced life. We have tons of free resources for women. We have our conference coming up. I'll mention that in a bit, but we have a podcast twice a week. We're actually published by Bigger Pockets. I'm sure many of you are familiar with Bigger Pockets, but our podcast is published by them, and we do 2 a week. We have a free Facebook community, we have free meetups. Tina, who's part of the chat, is one of our wonderful meetup leaders of women, circles of women coming together. And we also have a free membership and also a paid membership, which is our Strive, which is accountability. And we also have an EXP team. So we got a lot going on the investor front. So let's get to scaling, because that's why you're all here. I wanted to share a little bit about my background, what I'm passionate about. And I love real estate, but I really love empowering all people, especially women, to really invest in real estate on your own terms. So I'll speak to that as we kind of navigate scaling. So what is your biggest fear? If you can, put in the chat box, what is your biggest fear when it comes to scaling your portfolio? So it's a really important question, right? Because, it's a big one, and there's a lot of fear around scaling. I know we constantly, every time we went to a different level or tried a new thing, we experienced that fear, right? It keeps coming up. And it's a human condition, right? It's never going to not come up. So if you can share what pops in for you in terms of what your greatest fear is. Lenders, Lorenzo's saying, Amir is saying employees. Certainly, yeah, as you scale, you're going to have to enroll and connect with more people in some ways, right? So that is certainly the case. Any other fears? I'll just, I'm going to force everyone to interact with me here. Yeah, liability and lawsuits. Certainly, as we scaled our portfolio, your liability increases, and certainly lawsuits. I will not disagree with that. Taxes growing too fast, too soon. Yeah, that's real, very real, Tina. Market fluctuations. Yeah, things you can and cannot control, right? And how to really. That's a great point too, Joel. Not having the management bandwidth, right, to handle the many additional units. I'm not fearful, but convincing my husband not to be is my issue. Yeah, right. Enrolling our spouses, which I can definitely speak to because I've worked closely, I've worked strategically. I've worked all kinds of ways with my husband in the last 16 years. So good stuff. Thank you for sharing your fears. We all have them. I still have them in different areas that I'm working through in my own businesses, in my own life. It's all about not being stopped by them, right? And it's about being mindful what they are and then getting the support. So I am a very big fan of finding a group, finding a tribe, so you can get some support from people who've been there and done that. So here's what also are some things that have popped up for us in our journey. Time. As you scale, you think, okay, wow, if I add another building or add a building out of state, my time is going to start to get squeezed. I'm going to have less of it, right? So that's true and not true. And I'm going to speak to that, or kind of turn that upside down a little bit here today for you. Money, obviously, as you scale and get into larger projects or bigger projects or more of them, you may be kind of really tapped with your own resources, your own financial resources. So I'll speak to that too. knowledge is a big one too, that people are fearful of or just have challenges around. Certainly, if you're underwriting a 4-unit and you're managing a 4-unit and now you get a 50 unit or a 100 unit, right? It's not that it's an unknown, size, but it's certainly, there's a whole other element. There's a whole other, business plan that has to be, looked at and created for larger assets, right? Because you're scaling and you're doing more units versus maybe the 4-unit or the 10-unit, depending on that piece of it. And then confidence. I know, again, I'm going to speak from what I know most, and a lot of the women in our community that I talk to, the honor to talk to and connect with, and the women in our membership and our meetup leaders and all the fantastic women we interact with. Confidence is a big one, meaning, and this is for all people though, in a lot of ways, of just saying, okay, I may not be confident here, and how do I move through that so I can trudge into something new or expand what I'm doing, right? So these are all real. They're all very relevant. And I just want to speak to it before I get into the tactical lessons I'm going to teach, because these are things to be very mindful of, and not for them to stop you. They're relevant. They're something you need to be intentional about and be mindful of, and then think through, how do I move through this with a lot of with confidence, but also with not allowing it to stop you. So just want to mention that. I think when I've been interviewed on podcasts, to be perfectly frank, in investing for as long as we have, in growing a portfolio, when people say, what has been the secret to your success? I mean, I wish I could say it's my this or my that, but honestly, it's not giving up. And so challenges and fear are going to be with you, but it's about not giving up, right? And that's what I can tell you from the bottom of my heart as really important. So let's now get into some tactical stuff around some case studies and some specifics, because I kind of put this presentation together with my actual projects that we've purchased, that we've managed, that we've bought, that we should have bought, some we shouldn't have bought, and everything in between. This is not all the projects we've done. Obviously, we've done a variety of buildings and bought a bunch of buildings over the years. But these are just some highlighted projects because it's going to help teach the lessons I want to teach here today. So let's get into it here. The 2 single family homes to 670 units. So we started, we started actually in 2004, but this was one of our first private money deals. That's why I wanted to use this one. And it was 2 single family homes literally right next to each other. It's our first private money deal. And we've been able to scale this is our latest project. This was like 2 months ago, 670 units. These are 5 buildings, 2 states, Kentucky and North Carolina, which are 2 markets that we focus on. And it was a $60 million project. So again, I don't think this is linear, right? This is not like this happened and this happened. I'm not going to even begin to even tell you that that's how it went, right? Because all of our journeys are up, they're down, they're twists, there's turns, there's wins, there's losses, there's laughing and happiness, and then there's like tears and crying and everything between. So as I share scaling, it isn't just this way, right? But once you start to create momentum, it can kind of create this neat momentum versus we bought more in the last few years than we bought in the first like 13 years because of the momentum, right? As you start to build something. So I'm going to kind of go through each thing. So back to 2004, that's a picture of me and my husband, literally a long time ago. I know that looks like it was yesterday for me, for all the nice people on my corny jokes that I say. But so we had no money, we had no experience, we had no connections. I'm being funny by no problem, but it's true. And so when we started, we really didn't have much to pull on, except we were in our 20s, we were young, we were hungry, and we were going to make it happen. We were pretty focused. So that's just a little bit. Like I said, read Rich Dad Poor Dad while I was in social work school. So we started with a project outside of Philadelphia, and then we quickly kind of got focused on the market of New Jersey. That's kind of where we bought all of our initial projects. We still own properties in New Jersey. We're actually doing a development deal, a 30-unit development project there right now, but we've sold a lot of our projects as well there. And then we expanded into Pennsylvania, Kentucky, and North Carolina is where we do our most of our business now. We're actually looking to South Carolina and some other states to expand. So these are the 2 single family homes from 2010. I want to share a little bit. Some of you said about creative financing, and financing as you scale. At the point of 2010 for us, we were investing for about 6 years by then. I'd say we had about 100 units, and we were completely tapped out of, we had used some lines of credit. We used our, a loan from our parents. We scraped together some money. Like we just really just tried to figure out how to, buy assets and units, working with like literally our parents and my in-laws. And we got to the point that we needed to think creatively to buy the next assets. And we had the knowledge, we knew our market, but again, we didn't have the funds. So this is an important way to think of as you scale and you start to say, okay, how can I potentially partner with other people? And maybe your first partnership is not a syndication. Quite honestly, I don't think it should be. Me personally would tell you, syndication is a whole other, meaning you're pooling money together, you're filing with the SEC. There's a whole process and there's a whole legality around doing that correctly. And we've done a ton of various syndications from DeRosa Capital 4. We just closed on 16. So we've done a lot of syndications, but I'll also say you can scale and partner with people in a way that you don't have to syndicate, right? And you obviously want to be very careful on how to do that. I'm going to share with you this example to get your wheels turning, because people always think you have to partner and find, 15 people to do that. You don't necessarily have to do that to start or even to scale. So this was 2 bank-owned properties, both single-family homes. I think we got this from a wholesaler. And this was in Trenton, New Jersey, where we knew the market very well. The buy price, again, this was some time ago, but regardless, this was in Trenton, which was still, an up and coming city. So you could still find things probably not much higher than this still. So these prices are pretty relevant still, even to today's market. But regardless, the buy price was $25,000 per house. They were both pretty beat up. And we knew that, where our rents would be, we knew what they're worth. And so what we did here is that we found a private money partner, a private equity partner, if you will. And he was an active partner. We were active, he was active. That's also really critical. It's not passive. Syndication, think of syndication and syndicating like larger apartment complexes. We worked with over 200 investors in our last deal. They were passive investors, right? Passive partners. This gentleman here was not a passive partner. He was an active partner. Okay, what makes him active? He obviously, one of his roles was putting in $50,000. We put in $0. He put in $50,000. We brought experience. He also brought to the table, he was really financially over the financial oversight of the project. So he audited the books, but just was the financial oversight. And then he also personally guaranteed the loan once we refinanced, which at that point was very helpful to us. We weren't as bankable at that time. We were both self-employed, and we didn't have a whole lot of assets under our belts that were, from a bank of being bankable for institutional lenders, they wanted to see more. They wanted to see a W-2. They wanted to see more liquidity, those sort of things. And at that point in our business history, he brought that to the table even better than we did. We brought the experience, we brought the relationships, we also brought the whole, kind of being at the property, right, on a daily basis to get the properties turned around. So I just tell you that because so many times when we scale, people think like you have to go big or go home. And we really scaled in very small steps. And I can't speak enough about that because you learn a lot when you do it that way from, doing this project, then doing a 10 unit, then we did an 18 unit. We kind of grew very steadily. And I don't think enough people talk about that because everyone's like, buy this huge building overnight. Like you can do that, but there is value to taking it in small bites. And again, I can't speak highly enough of being mindful of how active partners are. And this was not a syndication. This was just 2 active partners coming together, with an, obviously operating agreement, making sure the roles were very clear. And there's a whole other litany of being careful when you're partnering with people, but this is one way to do it. We ended up bringing in a private lender to loan us the other 50,000 so we can not just buy the units, but then renovate them. We refinanced, pulled my partner's money out and did it again. So, and we were making cash flow. We held this for 7 years. So this is a win-win-win all around, this project and this property. But again, hopefully it gets your wheels turning about the value of bringing partners in early on, and they don't have to be a syndication. It doesn't have to be a syndication initially.
Yeah, Joel has a great question is how did you connect initially with the property wholesaler?
Yeah. So two things. We networked, we knew our market really well. So we were like committed to Trenton, New Jersey. That was where we got our, that's where we kind of started to build as many relationships as we could. We weren't the kind of investors that wanted to do a lot of direct mail campaign ourselves. We built relationships. So I think so many times finding deals, you need to kind of figure out what's that 1, 2, or 3 ways you're going to find deals, and where do your strengths. Some people are amazing at cold calling or, at different strategies of finding, especially now, right? Because it's so competitive. We really went all in of just building relationships. And I think it was a wholesaler we built a relationship with. They knew we're active. They knew we wanted more properties. They knew we had properties. So they took us seriously. And then when they presented this to us, we said, great. And we knew the area so well. So we moved fast. And then we, were able to pull the money together. So that's how we connected. It was more of the building of, and that's how we built our business, quite honestly, is building relationships with commercial brokers as well.
Thank you.
Yeah, no problem. Hopefully that answered your question, Joel. This is kind of the next, and please keep throwing in questions. I have no problem. I don't get distracted by that. I think it's engaging and it'll keep this kind of interesting. This is kind of like the next set of kind of purchases for us. These are 3-4 units in New Jersey as well. This was not in Trenton. This was outside of Trenton, but this is really where we learned landlording, to be honest with you. We made all the mistakes that you're not supposed to make, like hiring your tenant to do different property maintenance. That wasn't a good idea. I think the other learned lesson here that I'll say as you scale is that you don't always know what expenses are going to really bite you in the end when you buy the property. So we overpaid for these buildings, hands down. It was a great learning experience. We ended up selling them about 8 years later and making money with that, but still we overpaid. So as you scale, especially from like a single family to like a 4 unit, like we did, there are expenses that are going to be included in those 4 units that you may not be as aware of, right, on a single family home. I always say, number one, what are the big ticket items? Your HVAC system, windows are a big ticket item for multis because there's usually a lot of them. Roof, obviously, and also just the age of the property. Don't dismiss that. I think for us, we always wanted to add value. We always bought beat up properties. We always bought older properties, 1970s, property. And what comes along with that is more deferred maintenance, right? Things that the owners have not been doing. So that's where due diligence is important. And that's why putting those cushions in are important. I'll also say that the taxes shift. We did not verify property taxes. I can't speak highly enough of doing this. When you're about to buy a property, even if the sellers, and you verify what in the past the property taxes have been, it does not mean that in the next year, the property taxes are not going to go up. And that's one of those variables that you don't have control over. Right. So I would highly recommend you to call that local tax office that the property resides in. Hey, I'm looking to buy 123 Main Street. Can you tell me a little about, what's going on with assessing property taxes, and let them tell you. They may have just assessed, maybe they're going to assess. I've talked to owners in our community. It hasn't happened with one of these buildings here. One of our friends, it happened to where their taxes were, they went up, doubled. They doubled in price, which is very significant when you do your underwriting, when you do your analysis, right? And then a year later, it's double. Well, that could be all your cash flow. So you really want to be mindful of those things. And again, all of our properties are managed by a third-party manager at this point. We're not hands-on landlords, but I'm really grateful we were for 10 years because we really learned how to be a landlord. We learned what's important. We learned about how to find, attract, and manage tenants, how to deal with maintenance issues, everything in between. So some people might disagree with me, but I think learning landlording and learning how to be a landlord served us very well in scaling our portfolio, hands down. So, and it's also helpful to know, what does it really take to turn around a unit? How much money does it take? Do you want to go, what are things you should be putting money into? And what are things you may not, you shouldn't be? As you can see in this picture, we put a brand new rug in one of these units. Don't think I'd do that again. Rugs are tough, right? Rugs, there's a lot of wear and tear in. So, and rugs are not cheap. Flooring might make more sense in a lot of our units now. We don't put rugs as much in. We did that early on because we thought that's what you should do. Again, I don't know if I would have learned that if I wasn't as hands-on. So these are just, learn lessons along the way. So, all right. So first lesson, focus. As you're scaling, I know for many people on this, I don't know if you've ever seen this movie Up, but it's a cute movie if you haven't seen it. But it's basically a Disney movie where this dog just gets distracted very easily. And so many times, I think in this business, we hear a podcast, we hear something out there, a new webinar, a new fill in the blank, and we think that's the strategy for us, or, we should go buy an Airbnb, or we hear someone doing great with self-storage, or another niche. And it can be very distracting. So I think for us, when we made the decision to go really all in on multifamily, our business accelerated, right? We were able to scale appropriately. And up until that point, we were flipping. We had a commercial building. We bought raw land. We were doing tax liens. We were all over the place early on. So I just can't speak highly enough about focusing, because it's so important to help you scale. We early on bought a 10,000 square foot building. This is one of the things we bought early on. This is, we got it at a really good price. We did a lot of rehab to it. It was great, but it was a commercial building. That's not multifamily. A 10,000 square foot commercial building in Trenton, New Jersey is not multifamily. And so that was a whole new business for us. And we bought this right when the market crashed. So there was a whole lot of companies that wanted to buy or rent, a 10,000 square foot building, right? They wanted small space. So we ended up creating a niche within, and we still own this building. It's actually under contract. We've owned this building for quite some time, since 2008. And we're actually selling it as we speak. And so this was in particularly very important that we cut it up, and we had about 22 tenants at the time, small office space, and shared space, because that was how we were going to do well with this building over the years. But you got to remember, every time you get into something new, there's a whole learning curve. We didn't know how to market to small business owners. We were dealing with multifamily or dealing with something else. So remember, the power in this business is to become really knowledgeable in an like high expertise level, where your customer, your niche, your market, so you can act quickly and what they want and need. So we learned that along the way, but this was a little bit of a derailed focus for us. But we've learned a lot through this building. Honestly, it's been an interesting ride, and really, really helped us in so many ways. But in hindsight, it didn't help us focus necessarily, which is important. So that's the first lesson. I want to get to the 10 unit. This is really when we started to one of our first syndications. And again, there's some great resources if scaling into multifamily and syndicating is something of interest to you. Not to be too self-promoting, but my husband, Matt, did write a book for Bigger Pockets called Raising Private Capital. I actually wrote it with him. It's a great book. I also suggest a great syndication book is Joe Fairless's book. You can get it on Amazon. I forget what it's called, but he has the Best Ever podcast. And it's an enormous book, but it's on syndication. Great book too. And so that's a whole other business, meaning, making sure you have the right legal docs, that you're working with passive investors correctly. You're having all the right paperwork, all those pieces of the puzzle. So this is a 10 unit. We end up syndicating this building, and I want to say another 6 units. So 16 units was one of our first syndication. And what was really helpful here, I'm sorry, 19 units. I'm totally off there. Sorry. My memory isn't serving me as well. But we pulled a number of properties together, and we hired, it's really important if you're navigating a syndication or looking to syndicate, a group of properties, make sure you work with an SEC attorney, someone that has experience in that. I thought that was very, very important early on that we did, because they're going to set you up with the right legal docs. And there are attorneys, and I can certainly make some recommendations that specialize in syndication, because it's a niche. It certainly is. And you, not only are you setting up your own operating agreement correctly with your general partners, but then working with the limited partners, which is how you grow, and that's who your passive investors are. You have to give them the correct paperwork as well, from a subscription agreement and all those important pieces of the puzzle, so that they're investing with you correctly, legally, and you're giving them everything you need to be giving them, all the disclaimers and everything along those lines. So this was a really important one for us, because this got us going in that way. I think I want to say we raised about $1 million for this project. And again, they were all passive. So remember, the first example I said was not a syndication, active partner. We both had roles beyond him just putting in 50 grand. This project in particular was about 10 investors, and all they did, right, was passively invest. So they didn't have any other role. That's when you have a passive, you're working with passive investors, which really equals syndicating, because now it's going beyond them as just an active partner. So that's an important piece. There's a number of ways to qualify or disqualify with the SEC. My husband actually goes through all the different examples on that in his book. So it kind of helps. So the basics of it. But again, please talk to an attorney. I'm not an attorney. I'm not trying to say I am or not. I'm just giving you my experience, but you got to have the right team around you, especially legal team, when it comes to syndication. All right. So let's talk about money, because a few of you in the chat box said you really wanted to get into financing, and that's a big piece to scaling. So another tip to share with you: when we grew our business, hands down by raising private money and working with private money partners, both on the lending side for our flips and for a number of projects, and then on the syndication side and multifamily side, more as equity partners, right? So debt and equity, we grew our business that way. I want to share with you, as raising money and working with private money partners is not for everyone. It's a lot to make sure you're not just protecting people's money, but you're that's number one, but you're being great stewards of their money. And then number three, that you're getting you're getting them the best returns you can, right? Because you are that person for them. You are taking on that role. And it's such a big role. And we work with a lot of investors now. We don't take that lightly. And there's been times that we had to put their needs before ours. And I come from the school of thought that if you have investors and you're working with people, working with private money partners, you should be putting their needs before yours, because they're the ones, right, partnering with you in that way. Not that you shouldn't be concerned about what's going to be helpful for you. I'm not saying that you should not at all be worried about that, but from a weighting perspective, you really need to think about them and their needs. I will say though, when you're presenting opportunities, and when we were talking to private money partners over the years, something that I hear a lot of people say is, oh, I got to go ask for money because I found this great deal. I got to go ask for the money. You're not asking for money. This is they're not donating money to your cause, right? That's not what this is. It's an investment opportunity. So coming from the space that you're creating a win-win, it's not a win-lose, right? They're not helping you. You're helping each other. So remember that as just a general concept when increasing your private money partners and as your scale, because you're creating an opportunity for them that they may not have gotten. So that's an important element to all this. What's neat about that I've seen over the years of raising money and working with investors is that, while you're building your own wealth, you're building their wealth. And that's powerful because it's a win-win. It's a win-win. It's not a win-lose or a lose-lose. So keep that in mind. It's an investment opportunity. And that's the way of being you have to have when you're talking to folks versus like asking for money. I just want to make a quick point to that because it's a way of being when we talk about our projects. One sounds a little more desperate, one's a little more confident. So
Yeah, and Marina brought up a really good point. How can you raise money on time when multis are hitting the market and seem to be bought within hours? Like, how does that
Yeah.
work?
You need to create, my suggestion is to create relationships as we speak, right? So meaning you could start to, and there people always say, oh, I don't know anybody with money. Everyone knows people with money. We're not talking like Bill Gates. That's not the people I'm talking about. I'm talking about everyday people like all of us, that are looking for an alternative investment. They don't want to deal with Wall Street, and they'd rather work. They really like real estate. And there's some, my husband in his book, and there's some great articles I can even send to you, Marina, but you start to listen to what people want and need. People who have a self-directed IRA are great people to potentially, work with you. People who might have a money in their home, like a HELOC, and they're looking to use it in different, obviously the right investment, of course, but the key is to start talking with people with what you do now. So then you can start to say, if I was to find a property and just create a property, this type of multifamily in this area, would this be something that, you'd be interested in partnering with me? And what would that look like? What would you do? What would I do? This is what I would kind of, so you start to have these conversations now, and we used to share mock deals with people that we used to meet and saying, yeah, I would love to work with you on that next deal. What would that look like? And then you start to give real numbers, right? It would probably cost around this. It may need this and work. The rents look like this, right? So then your market. They know that they know you're talking about, versus, well, an opportunity in maybe these 3 states. That's vague. We knew our market so well that we were able to say, we're looking to buy these kinds of deals, these projects that need this kind of work. And this is what we need you to do. This is what we can do. Would that be something you're interested in? And you start to have these conversations prior to any properties popping up, because that's hard to do when the property pops up. Like, oh shoot, I need a money partner. Oh, yeah. So does everyone.
I mean, I guess whoever takes those deals so quickly, they've already done all their research. They already have the partners ready to
just
go.
Like you'd be doing, and just like you'd be doing research on lending. I'm a very big fan of actually talking to lenders now. We just interviewed a woman for our podcast, and she gave some great suggestions. She was a mortgage broker, but having these conversations with institutional lenders now, with private money lenders, with all types of people now, that's the work. I don't think that's more important than finding the deals, because the properties can move so fast. It's those relationships that will be helpful. You can even share with a mortgage broker, hey, I'm looking to these I want to find this type of property in this type of market. Is that something you tend to lend on? What do you need from me? Then they start to get what's your credit score and what do you have liquid? And the conversation begins then. So I don't know if that helps, but that's Definitely, what I would recommend. I think.
Thank you.
Yeah, cool. All right. So that goes back to creative financing. I could probably teach a whole hour and or longer on this, but I will get into your thinking here. We really grew our business and scaled with 3 buckets of creative financing. And there's a lot, right? There's seller financing, which is phenomenal. We didn't do a whole lot of seller financing. It's also called owner financing. There's a lot of creative financing, I don't know, pathways. I'll just share the 3 that we used, and then really what we're using now in terms of like scaling into larger multi. So when we did a lot of fix and flips, the first one on the left is one of our first fix and flips. It's called, we're basically using like a private lender, which is called debt, right? There's a defined time, 6 to 12 months. There's a defined interest rate. It's a private lender, traditional private lender. And there's ways to protect them and you, and I'm not gonna have the time to go through all that depth, but that's really a private lender. Then there's that small equity, meaning you're active partners with each other. 2 people, 3 people, et cetera. There's an operating agreement. There's, again, looking at all the legality of it, but it's active partners coming together to buy a property. That's the 2 single family homes I gave you an example of. We did that on a number of deals with 1 or 2 partners. Then as we kind of really transitioned into larger multi, again, we got into that 10 unit plus 9 units, which was 19 units. That was one of our first syndications, meaning we couldn't just find 1 or 2 partners that we could be active together to make that work. We decided to syndicate and go down that path and have a number of passive investors that would just be investing money, and they were limited partners. That's really where we kind of then scaled our kind of, our business, if you will, in terms of larger multi. And that's where that's appropriate. So I just wanted to share a couple, a few ways that we've been able to do it, and just to get into your thinking of what might be relevant to the project I'm working on. I also know other people who get into decent size multifamily, like a 50 unit, 100 unit, with one or two partners, and they're both active, and they figure out how to do that. That's awesome. That just hasn't been our path. We usually found one or two partners on smaller deals. And when we scaled ourselves, we had to do it more on the syndicating and the passive investors. So no right or wrong, but there are different investors and operators who do things differently, just depending on their business model. So, okay. Then we kind of are moving into this 18 unit. Step two is all about strategic growth. So after the 10 unit and the 9 units started to get into some really good rhythm there, we bought the 18 unit, and this was outside of New Jersey. It was our first purchase outside of New Jersey. At that point, it was right in Northeast Philadelphia. And I'll say with strategic growth is that as you get into like the 18 unit, and this is all 18 units in one building, commercial brokers become critical to your growth, right? Because these are the folks that are at the helm. They're not residential. They're not dealing with small multis. They're dealing with a decent sized building. They're the ones that have those buildings or know of buildings coming up or are off market, et cetera. So we had to work really hard to get taken seriously from this commercial broker. At this point, again, we had about 120 units under our belt. We were in the business for some time, but we're not local to this market. This commercial broker never closed with us. So we had to work our tails off to get taken seriously, to be honest. And that's one of the biggest challenges, I think, as you scale and you're looking for maybe a larger building, is to get taken seriously and to build the relationships with the brokers. So a couple of ways we did that. My husband and I, one of our strengths, got plenty of weaknesses, which we could talk about, but one of our strengths, I would say, is building relationships, and genuine ones, right? Not just so we can get something, but genuinely building a relationship. So what we did here was I was tenacious. There was a particular broker I noticed who sold the most mid-size multis, like 18 units. It was pretty clear. There was one or two brokers in this area where we wanted to buy that were the most active. You can get that information in so many different places, but you want to know who are the players, who are the commercial brokers in the market you're looking to buy a building, who are active, who are closing deals, right? You want to get to know them. So we got a chance to know the person's name, and my husband and I kind of like tag teamed. I would call him. I met with him. He met with him. We met with him together. We got to know him. We stayed in touch. We tried to be top of mind. I mean, we hustled so we can build a relationship with him. And then this building popped up, and he said, "Hey, I have an 18 unit. I have a few people very interested. Can you get here this afternoon?" And we dropped everything and went there that afternoon. And I think there's something to be said about that. So many people work hard at building relationships, and when a broker calls you, or a broker says something or sends you a deal, you don't get back to them for a number of days. Like, you can't do that. You just can't do that to be taken seriously. So when we went there that afternoon, met with him, half the building was vacant. This was not a beautiful property. This was a big value add, like all the buildings we've done. There's a lot that needed to happen here, deferred maintenance. And we really gave him the confidence that we can close, and we did. And we held it for about 3 years. As you can see, we did well for our investors. I'm not going to be able to speak to this, but we did. Someone asked about a 1031 exchange. So on our podcast, episode 42, I actually tell the whole story of this 1031 exchange. It almost sounds like a fictional story, and it's not. But bottom line, we were part of a mini Bernie Madoff situation where we had a lot of our money. We had all the money that we made. It was about $750,000 that we, 500,000 was our investors' money plus the profit. This was going to be a 1031 exchange into a larger building, 220 units. And because the whole operating company, this was DeRosa Capital 5, was staying intact. We were taking that capital and profit and doing a 1031 into a new entity. And that happened because all the investors part of this project agreed to that, right? Which was great, but which was not great was what happened. And literally a week before closing, we had all of our money stolen from us, our investors' money, our money. It was a debacle of a situation. It's turned out well. We've gotten a lot of the money back. It was a tough situation. So my point in telling you this is that not all 1031 exchange custodians are created equal. It's a little bit of the wild, wild west. And we didn't know that at the time. We kind of thought it was like working with a bank. Like, there's a lot of backing and it's not, there's some custodians that are not as honest, and that's scary. I know of a couple that are great. Ask your accountant, ask your attorney. We just picked the wrong one. And that was tough. But regardless, if you want to listen to the story, check out my podcast episode. But I know of a great few. So if you needed a recommendation, I can give you one. All right, I'm going to keep moving before I keep talking about that. Now we're kind of moving into to where our next scale was, and I'll get to the next learn lesson here. Was a 49 unit. So how I was telling you earlier that all of our properties and what helped us to scale early on, and then to really get into more of a scale was locally investing, meaning we only invested within 30 minutes of our home. That was our rule. Like, we did not break that rule. And even the 18 unit was within 30 minutes. This was an hour and a half from our house. You literally would have thought we were traveling to Egypt to get there because it felt so far compared to what we were used to. So the point here, the learn lesson here, we started to get outpriced in our local market in New Jersey, in Philadelphia. We started to see the writing on the wall, meaning, for what you can buy the property, for what you can rent the property. It just didn't seem to be making as much sense as it used to. And every deal came across our plate. It just, the numbers did not work. Because again, at this point, we're syndicating. What's critical is that we, get the returns that we're telling our investors that we're projecting to get. That's really important, not just for them, but for everyone included in the project. And we just weren't seeing that as much in Jersey and Philadelphia at the time. So we decided to take a look at this property outside of our radius. That was really the reason why we started to look outside. And this was about an hour and a half. This is a little town called Lancaster, Pennsylvania, for those who are familiar. Great market. Very, very small market, very, secondary type of market, but great market, very strong arts community. This building in particular is a converted loft. Bottom line here, the learn lesson when you're scaling is to not be afraid to walk away. Meaning that it's really hard. We really like this building a lot. We don't fall in love with buildings, but out of all the buildings we've purchased, we just really, really like this building. The same broker who sold us the 18 unit, now we closed with him. Now we're starting to even increase our relationship with him because now he's taking us even more seriously, right? Which is critical. Now he says, listen, I got a property in Lancaster. Would you like to take a look at it? He wants 3.9 million is the ask. We underwritten it. We underwrote the property. It didn't make sense at 3.9. We didn't go see it. We just didn't make sense on the numbers and the rents that he told us. So he said, we'll offer you 3.4 million. The owner said, something not as nice, pretty much no, but I won't say the other thing he said, but they were not interested in looking at that offer. And we had to walk away. Now, at that point, we really, like I said, this was right by a train station. It just checked off all the boxes of this property you would love to buy, to be honest with you. And there's a value add opportunity. It's just so many things. It just checked all the boxes. One of those dream properties, right? And we walked away. We said, we're not increasing our offer. It doesn't make sense. And that was tough. And I think in this market, in order to scale, we think we have to just start saying yes and compromise our deal criteria. But I want to just reiterate to all of you, so you can not just protect your wealth, but build your wealth. You got to stick to your numbers. I don't care what kind of market it is. I don't care how hard it is. I don't care if you're getting outbid. Stick to your numbers, because if you overpay, it's going to come back and bite you. in different ways. So stick to your numbers that make sense to you. So 6 months later, really long story. This is a good story too, but really quick story. 6 months later, the owner comes back. The broker comes back saying, listen, you know that property, Lancaster? You guys liked it. You offered 3.4. He said no, and a few other things. The buyer he had fell through a day before closing, and his mortgage is due. It was one of those balloon mortgages. And if he didn't sell this building within a month, he's going to lose it now. So now he's motivated, right? Obviously. So we drove up there, negotiated, and I think we settled at 3.3, which was made complete sense. And it's been a great property. We still own it today. But it's another lesson as you scale. We so badly wanted to buy more properties and grow our business, but we were able to walk away. And that was something that really served us because it ended up coming back and it was meant to be. So I just can't stress that enough. Be willing to walk away, stick to your guns. What's your deal criteria? Don't overpay or get too connected to the craziness and the frenzy. It has to make sense to you and your numbers. So I want to make sure I said that. I'm not going to get a chance to through all this, but the bottom line was that this is a little bit about what our loan looked like. It was about 2.5 for those who like numbers or kind of breakdown of numbers. I think that's always interesting. Equity required was about $1 million. And that's really where, as you syndicate and you work with passive investors, the equity that you need to buy the building is part of it. And you can also build in potentially, and which we've done as we've gotten larger, a construction budget, right? So as you start to, what you're raising for is not just equity, but it's also the money that's needed to turn the building around. And this is just a little bit of how we broke down our investors. Some had already worked with us, some were new. And we started really becoming a thought leader, meaning sharing what was working for us very authentically, very transparently. We started a YouTube channel back in the day, me and my husband. And that was a really helpful way for us to share what we were doing. So people knew we were legit and people knew that we cared about our buildings and we weren't just, whatever other people are. We really were active investors and active landlords. So, I want to keep moving because I'm getting long-winded here and I want to be mindful of time for all of you. So again, same broker sold us the 18 unit, 49 unit. Then he brings another property to us, which was 198 units. That was the first property outside. Again, we went an hour and a half driving. Now this was in North Carolina. This is our first property in North Carolina. And step 3, or the third lesson I want to share with you, financial growth isn't just the money you need to buy the building, but it's everything, right? It's the relationships with the right lenders, institutional lenders. It's managing the money from a construction perspective when you start to renovate. It's working with the right third-party managers from both a financial perspective and from an asset management perspective. So the growth really is critical, right? That you're managing it correctly. A couple of learned lessons is we really learned you can't do it alone. Me and my husband were doing a lot ourselves. And when we went to a new state, we really needed to find some new partners and build that team in a whole new state, which is scary because we kind of, again, we already went from New Jersey to Pennsylvania. Now we're like going to North Carolina, which was a big stretch for us at the time. I will say as you're scaling, some people do keep in management in-house. We decided to take the third-party management route. And, we ended up having to fire our first property manager on this project. And there was a lot of reasons, but I will tell you, as you scale, make sure property managers, a couple of key things, that they know the market inside and out. So if you're going to Atlanta, Georgia, they better know Atlanta, Georgia. They need to have assets, your type of assets in Atlanta, Georgia. That's the second rule of thumb, is that if you're looking to get into short-term rentals, or you're looking to get into self-storage, or you're getting into multifamily, Class C multifamily, they better have experience in that niche and that area. I can't say the same for one of our first property management. They had experience in the type of asset. They actually didn't have as big of a footprint in this community. And this community, we always hear it, but real estate is hyper local. It is. It just is. And you need people who know that market, that local market, really, really well. And our property manager just kept kind of falling on their faces around that initially. We did hire a second one who kind of helped us through that transition. And that is not a fun transition on a 198 unit. It takes a long time to transition. So you want to avoid that as much as you can. I have some tips for market analysis because we had to find a whole new market. You probably looked at these things before, but a couple of things here as we scale, we became better at market analysis. We kind of knew our little market in New Jersey, but as you scale, the need to like, how do I vet this new market becomes critical. And these are 4 things that we looked at. Obviously, supply and demand, population growth. What's the competition look like? Rent, amenities. What buildings are your competition? These aren't things that I even thought about when I bought a single family home, right? But these are things that are really important when you scale into larger multifamily. Obviously, jobs and growth are critical. Don't just look at job growth, look at job diversity, meaning there's different sectors. There might be healthcare, there might be tech, there might be, Kentucky is one of our markets, and they have horse farms. They have, a number of colleges. They do have corporate jobs in different sectors there, which helps. And then obviously class of neighborhood. What's the cost of living? What's the renter that you're serving? What's the crime? I always like to you always want to drive around the building, not in the daylight when it's dark, because that's when you're going to see some of that happen, or not crime, but things happen when it's dark usually. So you want to be mindful when you're analyzing deals and buildings. Try to go when it's not 9 a.m. on a Monday. Okay. I'm going to skip through this because there's a lot here and I have too much detail here. So, which I tend to do, which next project. This is the last of 2, but it was a 222 unit in Kentucky. Again, we got to be really good at as you scale and you start to say, okay, what's the next market? What really worked for us, or a lesson to share with you, is that we like to find like under the radar, growing, stable markets. That worked for us. Some people like, they like very populated cities, meaning they don't like secondary markets. Some, operators out there. We actually like the smaller secondary communities and cities because they're less crowded and they're less competitive. Now, people might say that there's less labor in those cities as well, which can be true, right? Versus if you're looking at, a Philadelphia versus a Lancaster, yeah, Philadelphia is going to have more people that could maybe work at your project. However, those secondary markets also have people to work and help you with your projects. And we've never found that to be a big issue. This was all about leveraging relationships. So we had to really step away. This was also when I started to step away from doing, kind of day-to-day with my husband, and he took over the day-to-day, and we started to grow the team as well. So that's important. There's a lot of detail here. So step 4 is all about partnerships and teams. Someone asked about technology. So we used to manage all of our investors in a Google Doc, and that became really tough as you scale. So I would also agree that the systems and communication, how you communicate with your team, the systems you use to work with your investors, all of that becomes critical. And we use a portal now called InvestNext. And that's where folks that we're working with, passive investors, can log in, see what their investment is, all those sort of things. We've found if you're scaling on the syndication side, it's really helpful to have a portal, and InvestNext has been great to work with. But it's all about playing a bigger game, right? As you partner and build a team, you also have to work on yourself. And I don't think enough people talk about that. We make it all everyone else's problem, when it really it's we have to grow, right? We have to learn better leadership skills. I would also say as you scale, highly recommend, what's it called? The book, it's called, Gino Wickman is the author. He wrote Traction, which is a great book. Rocket Fuel, that's it. So the book is called Rocket Fuel, and it's basically helps you identify, are you more of a visionary, or are you more of an integrator? And as you scale and you think about, okay, what's the new project for me? Really owning and knowing who you are in that recipe is going to be critical. And it was critical for us as we grew. And so we can really start to say, okay, how do we grow with everyone else's strengths? Just lastly, as you scale, you start to build a team. Stop doing the things you're adequate, doing. Those are the easy things to let go of. I would even tell you, stop doing what you're great at or you're good at. Start doing as you scale, you have to do what you're like amazing at. It's called your core genius. And it's a concept that a gentleman named Dan Sullivan, who's he's written like 40 books. He founded Strategic Coach, great coaching program out there. Anyway, he wrote a number of articles and books around a core genius. So I didn't coin this term. I want to give him credit because he's just a huge, phenomenal thought leader in our business world right now. But anyway, the bottom line is as you scale, you have to figure out your core genius, not just figure it out, but really go all in on it and build a team around, where everyone can really bring their core genius. That's how you're able to operate a large portfolio or even just going deep with people in terms of more, because you can't be good at it all. You don't want to be good at it all. So just a sidebar there. This is our last project. Just to share a little bit about the learning here. This is a diversified value add portfolio. I would say as you scale, something I just want to mention before we end and see if there's questions here, Alexandra. But I want to mention that we became really good at finding buildings and renovating buildings that were like a huge value add, like true dilapidated buildings. We did that in Trenton on the single family homes. We did that on this 670 unit portfolio. So we found our niche, Class C, working class environment, middle class, and really turning around truly dilapidated buildings, interior, exterior, into very nice livable space for people, quality housing in really secondary markets. That's our niche. I'm very clear on that. We're very clear on that. And when we became clear on that, the scaling was able to happen. So we're not involved in doing this or that or something where we started when we were early on. So I don't know a lot of people who scale and aren't really focused with what their criteria is for the type of properties they want to buy. Our unit size has increased, but the type of property has remained very, very consistent. So I think that's allowed us to scale much quicker in the later years of our kind of tenure, if you will. Had we been doing this and that, I don't think the scaling would happen, right? So I just want to mention that because you start to, although this is our largest project, this took less time than other projects in the past because of, or even the money raised because we were so focused. So, so that's what I got for you. The last step, and then I'll stop talking here. But the last step is all about processes and systems growth. That is not our core genius. And so we have a phenomenal partner now who does our asset management and really helps with like putting the right systems in place, following those systems, using the same communication techniques, and how you go about your day-to-day. Property management team, our team, everything. To say that I'm amazing at processes, or my husband would be lying. We're not. But you have to know what you're great at, and you have to build with partners who are also great at other things that you're not. And I don't care who it is, but somebody on a team as you scale has to be really good at this, processes and systems. Because if you're not, it's not going to be repeatable, right? You're not going to be able to repeat what you just did. And that takes a lot of energy and time. So that is what I have. A couple summary, and then we'll get some more questions. Don't be afraid to start small, get in, figure it out. I can't stress that enough. If you want to scale and you haven't done your first deal, get your first deal done. Don't worry about scaling. Just get something done so you learn from it and grow from it, and start small so the bruises are smaller. And don't underestimate expenses, especially as you scale. Don't be a student, especially initially. Don't be a student in multiple asset classes until you've mastered something. That's my opinion. Become a master relationship builder. That's what one of our strengths was. But what is your core genius? And become good at it, and then you can build from there. This is just the name of the game right now, but be willing to tweak your business plan. Constantly ask yourself, what is working? What is not working? You can't just put your head under the tunnel and expect it all to happen. You have to be really flexible and adaptable. And you have to be scaling yourself. If you want to scale, you got to scale yourself, learn new skills, techniques, surround yourself with great people. So anyway, that's what I got for you. I got a freebie. I got the conference. I got questions. Hopefully, I hope this was of value, Alexandra, but you have some questions?
Yes, we have a couple.
Okay.
You can go to the website here that's on the screen, but I also put up a poll question if you want that partnership guide, which is just, I think you said it at the beginning, how important it is to pick the right partner and make sure you do it right. So this questionnaire should set you up a little better with some of the partners that you might potentially have. So a question that came in that I thought was interesting was, how did you find and build your property renovation team? Because that seems to be like you always had these sort of, rehab kind of properties. So how did you start with your team, and what do you use now for your team?
So all our team, when we were local, was all local people, if you will. So it was all folks that we vetted, we hired. We had a whole construction crew back in the day and that was not easy. I'll say that. Because you're dealing with personalities, you're dealing with different types of people. We had our property management team was all hired in-house when we were local. When we started to buy properties outside of our radius, and then we started to work with our first third-party management company, that the 49 unit really was the first building outside our 30-minute radius. We really had to find that right property manager, that property management company, I should say, because it's not one person, it's a company. They then become the entry into people to help renovate, because they'll often be the ones that are helping you do that, right? Because then you have to assess who's running construction. So some operators will give that construction responsibility to the property management company. What we've done traditionally is that we hold on to the construction aspect, meaning it's the operator, it's the owner who leads that. So for us, however, you could get vendor recommendations from the property management companies, because again, if you have the right property management company helping you on various things in managing the building, and again, the 49 unit was the first time we had an outside property management company. I don't know the right number. I can't tell you that. I'm just telling you my experience. It was a 49 unit to cause us. And some people, they manage a 49 unit. They may not have hired that third party, but they were the entry to resources and local people that we can kind of pull upon or work with, to deal with different aspects of the construction. The 49 unit in particular actually was the least value add. I mean, it was value add from rent and turning around some units. But once we started to go south, like North Carolina, the one in Fayetteville was probably the most, and then all the other ones in those two states. One of our team members, is his role, his partner, like his hat is asset management. And so typically the asset manager is managing the property management company. They're also managing the construction. Or you might even have somebody on your team who handles construction, who that's their job, is to find people in teams to bring in-house. It's funny though, I have to tell you, to be perfectly frank, because we've done construction on single family homes. We've done construction on now a 670 unit, 5 different building portfolio. When you have scale, and that doesn't mean you don't have issues or challenges, because you have them everywhere with different people. However, when you have scale, in some ways it's there's more kind of regularity to it, meaning you're turning around 10 units. So the ability to find a team to do that in some ways is easier, not just easier, but it's more streamlined than maybe that one property, because now there's like a whole process to that. And then you have money aside for it, and things kind of, are happening beyond any sort of delays, which, everyone's dealing with some delays and supply delays, but overall things are moving along. Hope that answers the question.
Yeah, that was great. Melissa says here, I'm scared with where interest rates have gone. I've had to put a pause. Any comments on that?
Yeah. So interest rate is interesting. I'm going to go back to, I want to talk about InvestHER, but I want to go back to this property in particular. Do I have this one in Winston-Salem? No. 2 of these buildings are in Winston-Salem. So just to give you an example though, think of interest rates. I mean, historically, they're still low. That's the good news with interest rates. And you got to remember value, the buildings we're buying or the buildings that you're going to buy, you have to look at rental growth, because rental growth is going to offset in some ways an interest rate increase. For example, like especially in Winston-Salem, I don't know which of the building it is, but it was because I don't think it's these. I think it's the previous ones we own there now. We've raised rents 5 times in 1 year. because the rents were so low, and it was, we were able to do that because we were adding value and this and that. So 5 times. So, and we've been able to raise rents everywhere because the buildings we're buying are more beat up, and they're just undervalued. The rents are just are under what's market rent. So remember, if you can keep your rents in line with interest rates, they should be more kind of consistent or growing together. That's the good news. But also, being mindful of what the numbers look like now. And you also have to be conservative in your underwriting. I'm totally, people are not conservative enough. And so, if everything has to work for a property to make sense, that's to me dangerous, right? Meaning like, this number, this all has to be perfect for this to even make sense is not going to be good in any way, because now you have no cushion. You have no ability to have like any sort of conservativeness to what you're doing. This project, these 5 buildings, 670 units, we underwrote it that if they all they were all in the 90s occupancy, high 80s, low 90s. If these went to 60% occupancy, we would still be in a break-even situation. We would be able to pay our debts to the bank. So that was conservative to us, right? Meaning that would be bad if these all went to 6% occupancy. Honestly, we would not allow that to happen. But if it did, we still were able to break even. So knowing your break even, Melissa, is actually the most important question versus interest rates. But remember, rents going up, especially if you're in like a growing market, are all good signs. But yeah, you want to be conservative in your underwriting. That's more important to me than interest rates.
That's a great perspective. Thank you so much for sharing that. So I want you to talk a little bit about InvestHER. I know it's an event that you've been working on for quite some time. That's when we started connecting. So tell us a little bit more about it.
Yeah.
Before you head out.
I'm super excited about this because we've had our InvestHER community for 4 years. Started the podcast. We have a lot of free resources and meetups that happen. We have 53 meetups around the country. And so many women have asked us, when are we doing a conference? When are we doing a conference? So right during COVID, June of COVID, we did our first virtual event. Then last June, we did our second virtual event. And then as this year as we ended that, we had a few hundred women on. It was great, but it's virtual, right? So we said, all right, next year is the first one in person that we're going to have. So we really have poured ourselves into planning this. We have 20 speakers. We have 5 keynotes. Kim Kiyosaki is doing 2 sessions. She's keynoting. She's also doing I think she's reviewing an 18 unit. She's going to do like a good deal, bad deal kind of session. We have women talking about self-storage. We have women talking about syndication, scaling, certainly. We have the woman, one of these women, Shannon from Strategic Coach. She works with Dan Sullivan, the guy, the Who Not How, if anyone's ever heard that book. And those gap in the gain. But anyway, she's going to talk about like, how do you 10 times your business without more effort. So we have women, one of our keynotes is going to be talking about how to use your voice confidently. So with women talking about self-care in the sense of taking care of yourself and who you are. We also have women talking about core real estate investing strategies. We have mindful breaks. We have a mom's room for those who are nursing and need some space to do that. We have a lot of opportunity for women to get into circles and support each other and get to know each other. So it's not going to be a traditional conference. We're going to be even doing some live masterminding where we're going to solve women's problems. What's coming up for them investing. So it's a packed 2 days. We're pumped about it. Been working really hard on it. So I'd love to invite everyone that's on. If you know any women that are investing now or looking to scale or just looking to get to their first property, the conference will be applicable to everyone. But it's going to be great. We've got 29 companies coming to sponsor. They're phenomenal companies from tech to, syndication attorney, everyone, people that we work with, vendors that we work with ourselves too. So it's going to be a great couple of days. Invite you to join us. It's Charlotte, North Carolina, June 23rd and 24th. So it's on our website. Yeah.
So I put up the poll. If you said yes, I'll email you some more information about it directly, more details. And just so you all know, again, I'm going to send you the recording tomorrow by email. I'll send you some of the resources that Liz touched on as well. And Also, we talked about 1031 exchanges. We're having a 1031 exchange webinar actually next week. So I will go ahead and also include that registration link in there in the email, so you can register for that if you are interested in learning more about 1031s. And thank you so much, Liz. This was just fantastic. I think you really inspired us. I feel really motivated myself, and I learned quite a few little things that I didn't know about. So I hope all of you did as well. And please take the exit survey. I'd love to hear your thoughts on how it went. Melissa's saying, thank you for sharing. Thank you for being here, Melissa. We appreciate it.
Yeah. And please, I want to be as resourceful and helpful as possible. I'm very active in our Facebook community. We have a free Facebook community. Honestly, it's basically, if you just go to Facebook, it's it's InvestHER community. Seriously, tag me, ask a question, tag me. I would be more than happy to help you or direct you or however I can help you. Happy to support, and hope you do something with what you learned today. I don't think scaling happens overnight. It's hard work. It's rewarding, but it just takes small steps, and you need to surround yourself with other like-minded people who have your back. That's why I think I love our community, and I love communities like yours, Alexandria, that these are places to go and get the resources, and then to go try it, and then go back and go, hey, I just did this research and this is what I found. What are you guys finding? And to get into that community aspect. I don't know how anyone does this by themselves. I don't, because it's hard. So you need to have people around you that you can bounce things off of, so.
Absolutely. Well, thank you. That's great advice. I'll include the social media handles in the follow-up email tomorrow as well, so you can connect on there. Great platform to be a part of. So everyone, have a wonderful day. Thank you so much for sticking around. Thank you, Liz, as well, for being generous with your time. We appreciate it.
It was a pleasure. Great to see everyone. Thank you.
Take care. Bye.
All right. Bye.